Welcome to the How to Wholesale Real Estate Step-by-Step Building Corporate Credit module. Most people realize that the majority of businesses handle their day-to-day operations by using credit. Credit is becoming increasingly important for companies so that they can buy supplies, pay bills, and invest. However, establishing credit for a business doesn't happen overnight. Like anything valuable, it takes time to grow and establish. This lesson aims at teaching you how to generate corporate credit. Generally speaking, the older a business is, the more options it will have to build credit, obtain loans, and secure other lines of credit without having to rely on personal guarantees. But regardless the age of a company or its financial history, in order to obtain or gain more corporate credit, one has to convince those who control the money to give it to the business. Of course, it is understood that when those who have the money divvy it out, those who accept it do so under the conditions of the lender. That is to say, if your business receives a loan from Company J, then the company accepts the interest rate, payment schedule, and default terms. Accepting those terms is all part of shopping around to get the best deal on the money, but whoever you decide to use to get the money, and however big or small is your business, you should use corporate credit to provide your business more financial options to buy, rehab, and sell property, or maybe even buy and rent it out without risking your own credit. You should know by now that realistically the sky is the limit when it comes to growing your real estate business. However, inevitably you will run into barriers on the way up. One of those barriers might be the amount of money your personal credit score will allow you to acquire, or the number of private funding sources you can retain. By using corporate credit, not only do you overcome that financial barrier, but you distance your personal financial situation from your businesses. What you should know. Before beginning this guide, you should have a functional knowledge of the following: basic principles and terminology used in real estate investing. Which properties you are interested in and why. Where to buy real estate. How to locate motivated sellers. How to perform an income property analysis. How to accurately calculate an offer. Basics of the various investment strategies. What you will learn. This guide covers the following learning objectives. Understand what corporate credit is. Identify the various types of corporate credit lenders. Understand how lenders determine corporate credit worthiness. Identify the different types of corporate credit. Understand how to effectively build corporate credit. Tips for success. When you are looking into corporate credit, there are a few things you should consider. Fact 1. Small business credit reports are not always completely separate from personal credit scores. You may have heard that small business and personal credit are completely separate. They can be. Some of the business credit bureaus, such as Dun & Bradstreet and Credit.net. For example, don't collect information on individuals' personal credit histories, so that information will not become part of the business's credit score. But agencies such as Experian and Equifax also collect and maintain consumers' personal credit ratings, and they may blend that information with the business's credit score to produce a combined score for a small business. You may have also seen marketing hype about how a business credit profile can overcome a bad personal credit file. In most cases, however, it's important that small businesses have both good business credit as well as solid personal credit on the part of the owners. Granted, this potential problem can be overcome depending on whose personal credit is associated with the initial business credit lines. So if you have bad credit, you might consider writing up a corporate resolution stating that the partner with the best credit is the one whose score should be evaluated for the purpose of obtaining corporate credit. For example, Harry and David created an LLC named Paradise Properties. Harry had recently gone through a bankruptcy, making it so he didn't have very good credit. David, on the other hand, had great credit, so the two of them created a corporate resolution that they both signed and took to their local bank and presented when they opened a business checking account and applied for a corporate credit card. The bank then looked at David's credit and based the approval and amount of available credit on his credit worthiness only. Good credit is especially important in the current environment where investors and lenders aren't handing out money to anyone who can breathe and has a business idea. Even established businesses will find it necessary in some cases to provide the business owners personal guarantees on some loans or credit cards, at least initially. That means small business owners should be diligent about protecting, maintaining, and optimizing their personal as well as business credit ratings. Fact 2. The Paydex. If you have researched business credit programs, you have probably seen them refer to the Paydex score offered by Dun & Bradstreet. While it is true that this is one important industry credit score, it is not the only game in town. In fact, there are lenders that will never use a Paydex score to evaluate your loan. They will rely on other credit reports and scores offered through Experian, Equifax, the Small Business Exchange, and other business credit bureaus. Some lenders report to one bureau, but not to others. Knowing where you stand with each business credit agency is helpful if you are trying to borrow from traditional lenders. As an option, you could focus on those who only report to Danby. Fact 3. Paying your bills on time isn't enough to guarantee strong business credit. To build business credit, you must borrow or buy products and services from companies that will report your payments to the major business credit reporting agencies. If your payment history is not reported, it isn't helping to build your business credit profile. In addition, however, business owners should make sure they also have strong financial data about their company, for when it becomes necessary to ask a bank or financial institution for a loan. A business plan will also be helpful here. If you understand what lenders are looking for and approach a lender with a complete and well-thought-out proposal, you have a much stronger chance of getting approved. Fact 4. When it comes to building business credit, you will want to get it right the first time. Business credit reports are not covered by the federal law that governs personal credit reports. You do not have the same rights when it comes to disputing the accuracy of information in your file. Therefore, you want to make sure you start out on the right foot, or it can be difficult to get corrections or updates made to improve your rating. And the sooner you start, the better. Even if your business will make no money the first year or two, it helps to set up the proper business structure and take basic steps to ensure your business appears legitimate and stable to the business credit bureaus. That means getting the proper occupational licenses and a phone number that is listed with directory assistance in the business's name, among other things. Your business will generally need some form of corporate structure to effectively build a business credit rating. Your business credit plan should be part of your business planning from the beginning. In most cases, you'll want to have a solid 2-year credit record so that you can qualify for business loans that much easier. What is corporate credit? If you've never had any experience with corporate credit, it can be a little confusing. But even with the potential confusion, the benefits are numerous, so much so that it's certainly worth getting to know exactly what corporate credit means and how it can help your business. Corporate credit, or business credit, is a revolution in the lending world. Essentially, it is an unsecured loan issued to a business entity that, when done correctly, does not tie the business owner's personal assets or credit ratings to the debt. However, most financiers do still verify the business owner's personal credit record, but only as a means of establishing their credibility as a borrower. So the bottom line is, as a small business owner, you no longer need to try and finance your business by pledging your home as collateral anymore. Corporate credit also helps you build your financial reputation in the eyes of your suppliers and creditors. As you start building your credit profile piece by piece, your company will be able to apply for and receive bigger loans or credit cards with higher spending limits. In a way, it's an extension of your credit options, because with each new entity you create, you can open new lines of credit and loan options as a means of growing that particular business. You can gain access to a lot more money by having multiple businesses than you ever could by using just one or just your personal credit. If you recall, when you first started as a credit consumer, you probably got a credit card with a credit limit of a few $100s, but after just a few years you were able to borrow thousands, maybe even enough to finance a new car or buy a house. Your corporate credit works the same way. You qualify for a little at the beginning, but more and more as you use it well. And just like you can use consumer credit for a variety of things, you can use corporate credit for all sorts of things related to your business, including getting credit cards from retail businesses, establishing lines of credit with companies or banks that you deal with, leasing equipment or cars for the business, and, of course, buying real estate. With some time, patience, and good spending and paying habits, you'll earn a great business credit score and be able to get the funding you need to take your real estate investing to the next level. Now imagine if you had a few different entities and you built corporate credit with them, then you would have quite a lot of options for financing your deals and rehabbing them. It would almost be like your own private stash of private investors who have cash ready and available for you to use on different investments. And then the sky is really the limit with your investing. Aside from having the credit always available, another of the main objectives of obtaining and growing your corporate credit is to distance your personal finances from your real estate investing business. The sooner you can do that, the sooner you can truly have asset protection and limited liability in your real estate deals. You will also have more options available for financing aside from your single credit score. In fact, with corporate credit, you can have multiple credit scores from your different entities that you could use at different times and on different deals. Again, it just gives you many more options for financing a deal than you could ever have using your personal credit exclusively. Corporate credit versus personal credit. Just as our life has different monetary requirements at different junctures, businesses too have their financial twists and turns when they need additional funds. Raising personal loans for corporate use, while a very popular strategy, can have potentially serious negative repercussions later on. As has been mentioned, personal loans are given against your personal assets or credit. Defaults in payment may result in a bad credit score, low credit rating, blacklisting your personal name for any future loans/credit, or may even result in your personal property being lost in the event of legal proceedings. This potential risk creates the need for business loans, which are independent of your personal credit and property. Similarly, each time a bank or credit organization makes an inquiry into your credit score, it actually drops by about 2 points. Also, by obtaining personal credit for the business reduces your debt-to-income ratio and makes it less likely you can qualify for another personal loan in the event you needed one. Another thing to consider is that personal credit and loans are attached to your Social Security number, and any debt you accrue, even if they are used for the business, follow you until they are paid, regardless if the business is still operating or not. It is vital, therefore, to establish a line of credit under the business tax ID number as opposed to your Social Security number. For example, Debbie started an LLC that she planned on using to buy improved lots in Arizona. She registered the business, opened a business checking account, and secured a business credit card from her bank with a limit of $5,500. Unfortunately, Debbie was impatient and didn't want to wait and establish a larger line of credit. So she used her personal lines of credit to supplement the money she needed to start buying properties. Not only did she mix funds, she also tapped out her personal credit. The result was a credit stalemate. See, she couldn't obtain any more credit for the LLC because her current credit situation wasn't very appealing, which, in turn, made it so she couldn't build her corporate credit any faster, and she couldn't get any more personal credit since her debt-to-income ratio was too high. Debbie had to wait 6 months to get the money from the 3 lots she sold so she could pay down her debt and lower her personal debt to income. Only then could she continue building her corporate credit and accessing more funds in the long run than she could have using her personal credit. Corporate credit utilizes unsecured loans that are issued after verifying the business legalities and assessing its profitability prospects. Nowhere, unless when initially establishing corporate credit, does your personal credit score or assets come into play. In fact, no matter how much corporate debt you take, your personal credit score and rating stay unaffected. In spite of this existing benefit, some business owners still do not make an effort to obtain corporate credit. The most probable reasons for such a lack of effort must be that either they are uneducated in the concept of corporate credit, or they don't know how to build it. As a result, they deprive their businesses of the benefits corporate credit provides, such as low interest rates, no LTV, loan to value, and huge loan amounts. Corporate credit can help you in terms of taxes as well. See, different entities can write off more and more legitimate business expenses than are possible on personal tax returns, so even the government says it is in your best interest to establish and use corporate credit for daily business operations. However, be aware that building corporate credit is something that has to be done over time. You can't just suddenly decide you need money and walk into a bank and expect to get a good business loan. Just like you have a personal credit score, businesses have credit scores, and there is work and time involved with establishing a good business credit score. And similar to personal credit applications, business credit profiles are scrutinized by each lender that you apply for credit with. One of the big differences, though, is that while personal credit scores range between 300-850, Dan B business credit scores only go from 0 to 100. If your company has a score of 75 or better, it's rated excellent by credit companies. Such a good score can be achieved by having multiple accounts that are in good standing, up to date, and are using less than 30% of the available balance on them. Another thing to be aware of concerning your business credit score is that while there are several companies that collect information and determine business credit scores, it is voluntary to submit information about giving business credit, so there are actually relatively few businesses that know how to and take the time to report this information. Finding the companies that collect the information and submitting information to them is key to establishing your business credit. Overall, it takes some time for business credit to build properly. Therefore, it is prudent to apply for small corporate loans when there is no need for it so that you can build up your business's credit before you need it. Then, when the time comes and you do need a large loan, your corporate credit record is set to get the loan. One useful type of credit card for businesses is a gas card. A gas card will help your business build credit, but will also allow it to receive discounts and rebates on purchases, and can help track travel expenses, which, of course, can be a great tax deduction. Keep in mind, there are many lenders who are weary of lending money to anyone dealing with real estate investing, so you might have a harder time securing large lines of credit up front, but over time you can build corporate credit that will allow you to eventually secure large loans that you might use to buy real estate or other real estate collateralized investments. Why corporate credit? You have already learned several reasons why using corporate credit is a good thing for you and your business. But here is a list of even more reasons in case you're not yet convinced. It can get you the money you need. Without proper financing, you will never be able to launch or expand your business. Corporate credit gives you access to more money a lot faster. You can move on deals a lot faster, turn properties around a lot faster, and thus make a profit that much faster. The faster you can turn money, the more money you can make in a given time frame. You can sustain your business through tough times by having other sources of capital. You may not always foresee how the economy will change and either benefit your business or hurt it. Corporate credit can save your business during a slow period. It can save you money. Corporate credit rates are usually lower than personal credit rates, and even just shaving off a few percentage points of interest can add up to thousands of dollars in savings. So corporate credit keeps you from spending money you don't have to. Corporate credit can protect you. If your business fails, any loans you secured personally will follow you. Corporate credit typically does not, if it was established correctly. It helps you and your business establish credibility. By having money to invest and to use for advertising, it makes the business look that much more legitimate in the public eye. Therefore, if there are bird dogs looking for investors, or others who can offer beneficial services to you, they will seek you out because they think your business is progressing. It can be used to replace or in place of other financing options. For instance, maybe you have used your credit score to obtain a mortgage on a property and now you want to get it out of your name. Well, if you have built up your corporate credit to the point where your business can qualify for a mortgage, then you could use the business credit to secure new financing and get the loan off your credit and protect you from personal liability. Corporate credit can be immensely beneficial to companies that suffer from seasonal or periodic slowdowns, or to finance expansion projects that increase volume and enlarge potential revenue. You may have to pass up really good business deals if you don't have corporate credit. Passing on some of these deals could be detrimental to your overall business, especially in its early stages. If you have any type of corporation, LLC, S or C Corp, then it is imperative to your success that you build corporate credit now. Too many people make the mistake of waiting until they absolutely need it before they go after it, and as a result, they end up stressed out and in a pinch. So start applying now, especially since it can take a while to get those applications for credit approved. Types of lenders. There are a variety of different kinds of lenders when it comes to corporate credit. Here are some that you should consider looking into. Well, you can actually loan funds to your own company. The source for the cash could be equity from properties, cash in the bank, or retirement funds. If you do, though, you'll want to make sure you create a promissory note that states the amount borrowed, who it's from, who is receiving it, the loan start date and end date, the interest rate in terms of default. Essentially, just like you would create and document any other type of loan, other than you originate it. This is a nice option for those who have available cash to lend their businesses. It helps establish some corporate credibility while keeping your personal assets separate from the business. Family and friends. You'll want to be a little sensitive with this one since money issues between family and friends can get rather bad rather quickly. But family and friends can be a great option to start building some credibility. If you choose to go this route, make sure you follow the same guidelines as listed above to create and document that the loan took place and the terms for repayment. Commercial lenders. There are lending institutions that will look at your business's DANB rating and paydex score and determine if your business is a good credit risk. If it is, they will loan your business money based on what they deem is going to preserve the lowest risk for them. It's not an easy task, but there are some lenders who will allow you a small line of credit before you have a paydex score, but they will typically review your personal credit standing before they will extend that line of credit. Small Business Administration. The Small Business Administration will ensure loans made by commercial lenders for funding small business ventures. They will look at your business credit risk and determine if your business is a good investment and for how much they feel comfortable lending. In many cases, you will have a hard time securing SBA funds if you state you are going to invest with it. You'll want to make sure you show other financial needs that your business has in order to justify the funds requested. In some cases, you might have to be in business for 2 years before they will qualify you for a loan. Many times the bank with which you have your business checking account is the best place to request an SBA loan. Hopefully you have become friendly with the commercial loan manager and other account managers in the bank and have a good track record of paying your credit card bill on time and not going into overdraft on your account on a regular basis. State and local government programs. Your state and/or local governments often have loan or grant programs that you can apply for to secure funds for your new small business. Angel investors. Angel investors are private individuals, or a group of private individuals, who have funds that they like to invest in small business ventures. While looking for a suitable investment, they are also looking for an opportunity to make a great return on their money and will typically be more flexible in what they will lend money on than most other lenders. They will require a good rate of return for the money they lend, but possibly not as high a rate as a venture capitalist would require. Also, they will normally require a business plan with proof of an established business entity and see a track history of experience or at least a viable product or result. You can learn more about this kind of investor in the Working with Private Investors lesson. Venture capitalists. Venture capitalists are people who invest in business ventures by providing capital for startup or expansion. Venture capitalists are generally looking for a higher rate of return than would be given by more traditional investments, so they may be a bit more expensive than some of the other options. Typically, venture capitalists are looking for established businesses who are starting a new line or a new branch, as well as larger businesses to fund, so they may not be your best place to start looking for funds. How lenders determine corporate creditworthiness. In the credit world, many lenders use what's known as the 5 C's to determine creditworthiness. These 5 C's apply to individuals and to businesses, and they are: character, capacity, capital, conditions, collateral. The first C is your business's character. When a lender judges your business's character, they are looking at your size, location, years in business, number of employees, stock performance, when applicable, and several other defining characteristics. This is why it's very important that your business has a physical address, a business phone that gets answered professionally during business hours, and any necessary business licenses, according to your state's requirements. The second C is your business's capacity. Capacity assesses the business's current ability to pay its bills, but also by examining past credit histories, cash flows, and other previous debt. Therefore, it's vital that as a business owner you have paid all your credit bills on time and continue to do so. A late payment on a credit bill is a mark against your business credit and capacity that is not easily removed. Another important component of your business's capacity is to make sure you're building a credit history on your available credit lines. Don't let any available credit lie stagnant doing nothing. Recall that doing so actually reflects poorly on your business credit rating. If you have been using your corporate credit lines already, check to make sure the vendors you frequent have been reporting your good payment history. If you have yet to start using corporate credit, get some small lines, gas cards, home improvement store cards, etc., and use them. You will need at least 5 business references to obtain a Paydex score, and better Paydex scores bring your business better loan rates. The third of the 5 C's is capital. Your business capital assesses whether the business has the financial resources to repay creditors. This particular component of the 5 C's is usually the most closely inspected by lenders when considering a loan request. It's also a convincing argument against using your personal credit to fund your business expenses. The basis of your business capital is reflected in the business's debt-to-income ratio, and if the majority of your business credit is personal, you are making it very difficult for your business to be judged on its own merits. The fourth C is conditions. Conditions are the external factors surrounding your business. When evaluating conditions, a bank may consider general market fluctuations, growth rate of the industry, and currency rates. Because these factors are outside your control, it gives another good reason to start securing lines of credit now, because it may be even harder to get the money you need in the future. Furthermore, if times do get hard for your business due to market fluctuations, you will be very glad you already have some cash reserves in place to get you through the tough times. The fifth C is collateral. Collateral is essentially the tangible assets, i.e., equipment, real estate, etc., a lender can sell if the business defaults on its loan. Most new business owners have a little trouble with this one because there is typically not much the business owns, at least in the beginning. In fact, sometimes, new business owners will pledge personal assets for the company debt simply because the business doesn't have any collateral that can be offered to the lender. As has been mentioned, it's in your best interest, if at all possible, to refrain from offering your personal assets as collateral. Types of credit. There are several different types of credit you'll develop over the life of your business. Some of the forms of corporate credit include secured credit lines with your bank, unsecured credit cards, vehicle leases or loans, supplier credit lines, real estate mortgages, and equipment leases. But, simply stated, corporate credit can be broken into 2 forms, vendor credit and line of cash credit. Because of its fluidity, line of cash credit should be your main goal, but it is not always easy to get, therefore, vendor credit is a great stepping stone. vendor credit is only good at one location. For example, an office supply store may extend your business a $2,000 line of credit to buy paper, pens, etc. Or you might get a credit line through a supplies company such as a home improvement or hardware store that you can only use at that supply company. Now, these lines are good since they help build your credibility and business creditworthiness, but they are not the kind of credit that will really allow your business to grow and flourish into the future. Your end goal is to obtain a line of cash credit, which is the true pot of gold. This kind of credit gives you access to money that you can spend when, where, and how you want, and the money you get comes from banks, not individual vendors. So when you begin building business credit, make sure you are focusing on building the right kind of credit the best way you can and at the right time. But, keep in mind, you can't build lines of cash credit easily without having a business credit rating, so you must start with vendor lines of credit or credit card. Banks are generally quick to offer their credit cards to you for your small business or corporation when you open a business checking or savings account with them. But, while they are easy to sign up for, don't assume they're the best deal or that they will not show up on your personal credit. Take the time to shop around for the business credit card that best matches what you are looking to do with your business. Consider following these tips to help you as you shop around. Compare each card's features and benefits. You can even be a bit selfish when it comes to choosing what benefits you want attached to the card, but keep in mind that the point of the card is to build your business's credit, not affect your personal credit. Look for a card with low or no annual fees. Just by using the card, you're paying interest on your purchases, so why would you pay a company more just to own their card? You can find a good business credit card deal with low or no annual fees if you check out the various credit card offers available online. Sit down for a moment and think of how you'll use your business credit card. If you will mostly charge travel or office supply expenses, then your main focus might be on getting a low annual percentage rate, APR, whereas if you are planning on charging higher ticket items, then certain rewards might be more desirable for you. If your business consistently keeps monthly balances, every interest percentage point saved is money kept in your pocket. When credit card companies see you constantly carry a balance, they'll offer better rates. They may even offer bonuses as a way to get your business. A popular company credit card bonus is airline travel rewards. The way this works is, you earn points based on qualified purchases for airfare, hotels, rental cars, office equipment, or computers. These points can then be redeemed for gifts, restaurant meals, or travel. If you travel regularly, the points will add up fast and can even pay for the next business trip you take. Also, if your business travel is predominantly on one airline, you can get a credit card sponsored by that airline that allows points to build up even faster. Some credit cards offer cash back bonuses. As this is if bonus is more costly to the credit card company, don't be surprised to find that cashback credit cards also have an annual fee that ranges from $25 to $100. Unless your business uses the card enough to get back more cash than what you pay out for the annual fee, this card may not be the best deal for you. Some credit cards provide detailed expense reporting. This service can be very valuable come tax time, so it may be worth your time to look for one who has this service. Just make sure there are no added fees for it. Sit down for a moment and think of how you'll use your business credit card. If you will mostly charge travel or office supply expenses, then your main focus might be on getting a low annual percentage rate, APR, whereas if you are planning on charging higher ticket items, then certain rewards might be more desirable for you. If your business consistently keeps monthly balances, every interest percentage point saved is money kept in your pocket. When credit card companies see you constantly carry a balance, they'll offer better rates. They may even offer bonuses as a way to get your business. A popular company credit card bonus is airline travel rewards. The way this works is, you earn points based on qualified purchases for airfare, hotels, rental cars, office equipment, or computers. These points can then be redeemed for gifts, restaurant meals, or travel. If you travel regularly, the points will add up fast and can even pay for the next business trip you take. Also, if your business travel is predominantly on one airline, you can get a credit card sponsored by that airline that allows points to build up even faster. Some credit cards offer cash back bonuses. As this is kind if bonus is more costly to the credit card company, don't be surprised to find that cashback credit cards also have an annual fee that ranges from $25 to $100. Unless your business uses the card enough to get back more cash than what you pay out for the annual fee, this card may not be the best deal for you. Some credit cards provide detailed expense reporting. This service can be very valuable come tax time, so it may be worth your time to look for one who has this service. Just make sure there are no added fees for it. A business credit card is essential to building your corporate credit profile. Demonstrating reasonable usage and maintaining a good payment history not only allows you to gain more credit, but also helps you negotiate better interest rates on loans, lines of credit, and other revolving accounts. In fact, using a credit card properly is better than paying cash because lenders like to see a credit profile with positive activity. So shop around and get the best deal you can for your business. Now, once you choose a card and get approved for it, there are some basic guidelines that will help you manage your corporate credit card account so you reap the rewards instead of paying the price. Get the credit card from your own bank whenever possible. Once you establish a business banking relationship with a local financial institution, continue to grow that relationship by applying for your business credit card at the same place, because the more business you do with this bank, the more they get to know you. And the more they get to know you, the more their comfort level increases, and thus, the more likely they will consider your request for funding when the next time arises. Show loyalty to them and it will be repaid in kind. They may even look to regularly increase your credit limit on a regular basis because of your loyalty. Read the fine print. Many credit card companies shout out low introductory rates, but their key word is introductory. Then, after the introduction period is over, the rate can shoot up above the interest you're paying on your personal card. Also, there might be hidden fees that can rack up if you don't track them and know exactly what should and should not be charged. However, there are various other features that you want to make sure you get, ideally for no extra fee: overdraft protection, 24-hour customer service, and detailed account reports for your business. In the long run, these services are far more important business benefits than frequent flyer miles or discounts on rental cars that are often accompanied by numerous restrictions. Find a card and stick with it. With all the offers of lower interest rates and appealing incentives, you might be tempted to switch your account from one issuer to another. But, unless you are rather dissatisfied with your current company, stay put. Card hopping shows up on your credit profile and will likely be unimpressive to a prospective lender. Use your time to manage your business instead of pitting one credit card company against another. Don't mix business with pleasure. A business credit card is intended for business purchases only. In the event you get an IRS audit, and they do occur randomly, questionable expenses will raise suspicion that you don't want. You don't need a deck of cards. In fact, you shouldn't require more than one or two major credit cards for your business. The more credit cards you accumulate, the higher your debt potential, and it is easy to let credit card debt get out of hand. For example, say you charge $100 at the office supply store, then charge $300 of computer equipment to another account, and maybe pay $250 for gas, meals, and a nice little antique table for your conference room on a third account. That doesn't seem like much since each card still has a lot of available credit left on it, but if you do that consistently, when the monthly bills come, the totals can be a big surprise. And then, if you can only make the minimum payment, you'll never get ahead of the debt and you may have financial problems if your market gets tight. So make sure to keep track of the weekly expenses as you make them so that you don't heap up a pile of debt that puts a stranglehold on your business. In fact, each time you take a card out of your wallet, ask yourself if the purchase is necessary and valid for the company. If it's not, don't buy. A credit card is not a loan. The card should not be viewed as a source of funding when cash is tight because the interest rates and transaction fees are generally too high. Avoid taking advantage of the cash advance option whenever possible. Besides, if you're resorting to borrowing from your credit card, chances are you're not going to be able to pay the bill when it comes due. Limit the number of users on the card. A company credit card is as much a demonstration of trust as it is a convenience for the user, therefore, and this applies especially if you provide business credit cards to employees, you should review your monthly statements to verify that the cards are being used appropriately. Business credit cards generally function slightly different than personal credit cards. There are some advantages to them, and, of course, some disadvantages. Here is a brief list of some advantages and disadvantages to using business credit cards. Higher credit limits. Business credit cards carry higher credit limits, generally $50,000 or more, thus enabling expensive business purchases. This facility is generally not available on personal credit cards. Boost in credit rating. Wise and monitored business credit card handling and timely bill payment can help to boost your business's credit rating. Separate corporate credit. A business credit card saves you from the trouble of sorting out business expenses from your personal transactions. This makes the process of paying your business annual income tax easier. Fringe benefits. The benefits offered on business credit cards are completely connected to the business and may include discounts on business travel and shopping at business supply outlets. Business growth. A business credit card helps promote the growth of your business by facilitating timely purchases to meet immediate business targets. Disadvantages. Liability. A business credit card carries the same personal liability as a personal card until a business has established its own credit history. So if the business defaults on credit card payments, a creditor can come after the person who signed the card for payment. Moreover, until your business has its own credit, your business credit card will be noted on your personal credit reports, and a few late payments could seriously damage your personal credit score. Similarly, a big debt increase for your business could make you look more financially overextended than you really are, regardless of your personal payment history. Less consumer protection. Because business credit cards are meant to be used by companies, not individuals, they come with less information and fund protection than a personal credit card. Secured loans. Another credit option you can choose is called secured credit. With this credit, the lender will ask you to pledge personal assets or properties as collateral that will serve as security for the loan. This kind of loan will let you borrow a much larger amount, depending on your collateral, and at a significantly reduced interest rate. Secured loans can either be long or short-term loans depending on the lender and the amount you are borrowing. Unsecured loans. Short long-term loans. These kinds of loans allow you to borrow a fixed amount of money from a lender, and the money you borrow can be used in any way you wish. These loans typically have fixed interest rates along with payment terms ranging from 5 to 10 years depending on the amount borrowed. Lines of credit. Lines of credit are generally more for businesses who have been in business for 2 years or more. Most credit lines let you have a fixed amount of credit with the bank that can be used to pay for whatever your business needs. These are generally revolving lines of credit, meaning that as you pay debt off, you replenish how much you can borrow. The interest should be charged only according to the amount you have spent, and will reduce as you pay your debt until it reaches zero. What you need to qualify. The ability to get approval for corporate credit will depend on a number of factors, including the personal financial credibility of the business owners or operators, the quality of management provided in the operation, as well as the short and long-term profit forecasts provided by the company. The lender may demand guarantees from the business owners that they will be personally responsible for any corporate credit failings. In some cases, they will also require that corporate debts be insured against any losses. you must separate your business credit from your personal credit. As a means of doing this, you need to set up either an S corporation, a C corporation, or an LLC with your state of choice and register it with the city, if a local business license is required. By setting up such a business entity, you have essentially created a person that is separate from you and has its own tax identification number. Now, keep in mind that if you register a sole proprietorship or a partnership, you are 100% responsible for any money that you borrow. To avoid that responsibility, your business must have an EIN number, Federal Employer Identification Number, and be totally disconnected to your Social Security number. Your business should also open a banking account that's not linked to your personal account in any way. When you set up this account, you should be sure that the account has the correct business name and that it is spelled correctly. Your business should also have a business phone number that is separate from your personal phone number, and you might consider listing it with your local phone company as a business. You might also consider getting a separate mailing address for the business. You can get a box at a local copy center for cheap rent that even has a regular street address associated with it. Once you have set up this foundation, the next step is to make sure your business is registered with a credit agency. Steps to build corporate credit. Before you can actually start building corporate credit scores and credit, you need to have a credit identity first. Recall that this is done by registering your business as a corporation or LLC. Different states have different requirements for incorporation and credit building, which can get complicated if you're not prepared, so you might consider discussing the possibilities with an attorney. Also, please note that doing business as a sole proprietor will not allow you to distinguish your business credit from your personal credit. As a sole proprietor, you are doing business as, however, you are not a separate business entity. In order to establish business credit without a personal guarantee, you must structure your business as a separate legal entity such as a corporation or LLC. The financial institutions grant you corporate credits after verifying the soundness of your business as an entity. Once you have established your credit identity, registered business, you need to obtain an EIN as well as a DUNS number, Dun & Bradstreet. To get an EIN, simply apply online at www.irs.gov and one will be issued to the business. The application process is fairly simple and you can receive the EIN immediately. To get a DUNS number, apply online at the DANB website. After you have your DUNS number, the next step is to open a business checking account. Make sure you use the business's name on the account. You may also apply for a business credit card at the time you set up the business account. If you choose not to get a credit card through your bank, then you might consider looking into an SBA loan. SBA loans can also be great ways to begin building corporate credit. You can start applying for vendor credit lines right away, but you might have a better chance of getting accepted if the business has had time to make some money and pay off some loans, SBA or other credit cards. You can begin applying for credit through any vendors you work with. When you apply, make sure and find out if they report to DANB and or other credit agencies, Experian and Equifax. When you do this, you should also have your business's papers, operating license, DUNS or PAYDEX number, business plan, and financial statements, all ready. Take a little time to ensure that all the legal papers of your organization are up to date, including your business license. Often all of these will not be required, but if they are, it's nice to have them up to date and ready to go. One thing to note is that you might find that lenders want to look at your personal credit as well. Doing so is common in the beginning until you have a good payment record and PAYDEX score. You just want to make sure the loan will not show up on your own credit report. It's okay for them to look, but not to mark your credit report. It is not really a business credit line of the due. Another important factor to building corporate credit is that the business owner look after their own personal finances. See, when a bank lends money in the form of a business loan or business line of credit, they have to satisfy themselves that the business's officers are themselves creditworthy. In fact, Under the Small Business Administration guidelines, ensuring the business owners are creditworthy is one prerequisite for banks to access funds under the Small Business Act. Another element in building business credit is to keep good financial records and have a solid accounting system that not only tracks accounts payable and accounts receivables, but is also capable of making forecasts and projections about financing and cash flow problems before they arise. One of the major reasons that many small businesses fail is that they don't properly track their financial situation. In fact, simply staying in business past the first 2 years will improve your business credit outlook. After that 2-year period, business lines of credit generally become significantly easier to obtain. As soon as you are in business, begin working on building up your trade references. By the time you apply for large corporate credit, you should have at least 5 good references. It will also help to find financiers who can extend you business credit without requiring your personal assets and credits details. You should also ensure that these institutions, after disbursing loans to your business, inform the business credit reporting services so that they take a note of the credit. This is a valuable step towards building your business credit history. The most important element to building business credit is finding lending institutions, credit card issuers, and vendors that will establish business credit without you giving a personal guarantee. The secret to building excellent credit scores for your company is a 5-3-1 model. That is, starting with 5 vendor lines of credit, 3 business credit cards, and 1 business bank loan, all of which report to the business credit agencies and none of which are reporting against your personal credit. What to avoid doing? By avoiding the following common mistakes, business owners can greatly increase their chances of being approved for lines of credit or loans while at the same time building good corporate credit. Incomplete application. This may seem elementary, but check to make sure that you have completed all sections of a credit application. If a section doesn't apply, don't skip it. Instead, write an A in the response area. Also make sure you include all required signatures and that you write legibly, because if what you write can't be read, it can't be approved. This is especially important if you are planning on faxing or scanning application material. Incomplete supporting documentation. Include all requested documentation. If 3 months of information is required, don't assume 1 month will suffice. Have tax returns and other financial information readily available and ensure your business name and account information matches. Excessive incomplete documentation can make owners appear unprofessional and higher risk. Lack of timeliness. Return all documentation, phone calls, and emails in a timely manner. Slow responses and missed deadlines may cause you to miss special promotions and increase your chances of being denied altogether. Buying credit. Simply stated, you must not indulge in this. Some companies sell business information to other organizations. If you choose to try buying in on what they offer, your business will be classed as high risk, thus making future credit lines that much harder to get. Putting personal assets at risk. If you personally guarantee any credit extended to your business, you seriously risk your personal assets, such as your car, savings account, and your home. The most common way entrepreneurs fall into this trap is by setting up their business as a sole proprietorship. If you have not set up your business as a C corporation, S corporation, or LLC, then you most likely do not have an EIN. Instead, your business is tied to your Social Security number. This also means you don't have the legal means to separate your corporate credit from your personal credit. Not paying bills on time 100% of the time. Everyone who has some type of credit file also has a credit history attached to it, and having just one late payment on a line of credit can be held against you for years. This is vital information for entrepreneurs who are working toward building good business credit. Even if you have separated your personal and business credit lines, one late personal payment could affect your corporate credit and your business's growth. Rushing the process of building business credit. Just as it took time to build your personal credit, so too does it take time to build good business credit. The goal for building credit is to get cash, but added to that goal is to get cash without a personal guarantee. The industry standard for building business credit and securing cash loans without personal guarantees is 2 to 3 years. Do not rush your ultimate goal. Using personal credit to finance your business. The absolute biggest and most common mistake business owners make is using their personal lines of credit to finance their businesses. This includes paying business expenses with personal credit cards, borrowing money from personal savings and investment accounts, and securing personal loans to finance business expenses and expansions. This big mistake lowers your personal credit score because every lending inquiry into your credit history lowers your credit score. It reduces the amount of credit available for personal use because your debt-to-income ratio skyrockets. And, should your business fail, you will be personally liable for all those personal loans. You do not have to risk your lifestyle for your livelihood. By avoiding the above behaviors, you'll create a smoother, less stressful funding process for yourself while increasing your opportunity for credit approval. What about aged corporations? An aged or shelf corporation is a corporation that is already formed, but not in use and is ready for purchase by a new owner. There are many reasons that people purchase shelf corporations, and there are certain things to look out for when considering one of these ready-made corporations. Shelf corporations enable new owners to engage in business, credit, or real estate agreements as an established company without having to go through the entire process and waiting time of establishing a brand new corporation. Most potential creditors or business resources are hesitant to engage brand new or upstart corporations, so by approaching them as an established corporation or company, obviously, the more years the corporation has been in existence, the better, the more likely your company will be taken seriously. This may grant your business more access to credit lines, banking relationships, leases, etc. These banking relationships, agreements, Dun and Bradstreet type rating systems, etc., should all be considered when looking at potential aged corporations. Additionally, it is of paramount importance that these shelf corporations are acquired from trusted sources. If not done correctly, you could waste a lot of money and credit building time on a less than beneficial shelf business. One note of caution with this though, some lenders will note a change of ownership of an aged corporation and view it as an entirely new entity and thus requiring some of the same criteria as new corporations. So know who you are requesting money from and understand how they evaluate a corporation for a loan, then you can make an educated and effective decision. It is critically important that the shelf corporation you are considering not have any inherent or lingering liabilities. For the most part, this can be assured by looking into the history of the corporation and ensuring that the extent of its business activities were limited to the application of an EIN and maybe the formation of a bank account. However, there are some quantifiable exceptions to this rule. There are times when very well-established corporations get shelved, for a variety of reasons, and these can be inherently quite valuable due to the amount of time they have been in existence. These can be carefully scrubbed for liabilities and exposure by qualified entities. Be aware, though, these companies are priced according to how long they have been established, so if you want a long-established company, you will need to pay quite a bit for it. Simply put, if you are buying an aged corporation directly from its owners, there is a fair amount of due diligence involved. You should be concerned if the person or group selling the aged corporation has engaged in any transactions that may produce some type of future liability for the corporation or its stockholders. This may not always be easy to examine, and certainly requires some expert investigation. The best approach is to only acquire aged or shelf corporations from reputable providers, or resellers, who have a history of successful transactions in this arena. These providers can be counted upon to provide indemnification to the purchaser, a guarantee against pre-existing debts or liabilities, for the sale, and to conduct all of the due diligence prior to offering the shelf corporation for sale. Once you have found a reliable source and have selected your shelf corporation, it will enable you to establish an immediate history and instant credibility for your company and corporate image. In most instances, you will instantly be able to obtain lines of credit and obtain loans from the Small Business Administration in your state. Oftentimes, shelf corporations are confused with shell corporations, both in definition and their reason for existence. But shell corporations are completely different entities, both in scope and in formation. Summary. In conclusion, you have learned about some of the ways you can build corporate credit. The main reason why this concept is important is to help you understand that you have another option that you can utilize no matter what your personal credit or financial ability is. If you follow some of the guidelines set forth in this guide, you should be able to build corporate credit that you can use to fund your real estate ventures. Ultimately, the goal is to have enough entities created that you do not have to worry about securing funds from another source, that realistically you could have your own source of funds to build your real estate wealth as fast or as slow as you want. It's a great way to ensure you are protecting yourself from personal liability too, because if you structure your business and lines of credit in the manner that has been discussed, you should limit the liability to the entity in which you are using to secure the funds for the purchase of a property. If the deal leads to a lawsuit, you will not be personally pursued. All legal action will remain within the entity that is holding it. If you are not able to, or interested, in establishing your own corporate credit, you might consider establishing an LLC or corporation and bring on a partner who has his own corporate credit already established through another entity. Corporate credit is a very powerful tool that you can have access to and use as needed no matter what the financial climate, but you have to take the time to establish it. Be persistent. It will not occur overnight, and anyone claiming overnight corporate credit is trying to sell you a jaded product. Action items. Please do, or be able to do, the following before your next lesson. Meet with a reliable accountant or attorney to help you determine which corporation or LLC best suits your needs. Register the entity with your state and obtain an EIN from the IRS. Establish a business checking account and file with the business credit agencies. Begin building credit using the 5-3-1 principle. Pay your bills on time. Keep track of your business credit score and work toward a Paydex score of 80. Coming up, you should consider reviewing the business setup and marketing lesson in the Real Estate Basics course for a quick review on naming your business and other aspects of setting up a business that will be used for real estate investing purposes. Once you have done that, you can move on to other lessons in the financing course. You might also want to review the Working with Private Investors lesson and the Being a Hard Money Lender lesson. In the Working with Private Investors lesson, you will learn more about how a private investor works and how you might be able to generate capital for your business as well as your real estate ventures. Angel investors are also discussed in that lesson.